I'm an owner and advisor here at Compass Financial, and I want to welcome you to our semi-annual economic update. And my hope here is we're going to get a good update about 50% economic, about 50% dealing with financial markets, and then at the end, I'm going to cover a lot of local topics, things that are kind of hot and meaningful for Iowa, ag economy, local real estate, Iowa banks, Iowa demographic information, just to cover that. So I am in charge of our educational events every month, and we typically have a Social Security event in the spring. That is coming up in April, so please keep your eye out for that. We have typically a Medicare event in the fall, and that comes up in October every year. And twice a year, we try to do an economic and market update. Next month is something a little unique that I want to talk about. Typically, every year we have an estate planning event. And estate planning is really for one generation and how they plan to pass their wealth on to the next generation. And we do a lot of estate planning. There's a lot of estate planning information out there. And what I'm going to do is flip that on its head. So instead of talking about estate planning from one generation passing their wealth to the next, I'm going to look at the next generation and talk about all the pitfalls and tips and tricks and essentially how to inherit. Okay? So I'm going to look at the generation that's inheriting, and we're going to look at all the ways that you can inherit, all the ways it sometimes happens, all the rules associated with it, because we have a lot of questions. People come in and say, hey, I'm inheriting this. What does it mean for me, and what do I do with it? And how do I be wise? And do I owe taxes on it? And all these questions from the inheriting generation. There isn't a lot of information about that out there, so I had to create this presentation from scratch. So I hope you enjoy it. Please spread the word, and it's called How to Inherit. That's coming in March. I want to introduce the team. I'm an advisor here and an owner, Michelle Bjorkren. Where's Michelle at? Where is she? Okay. Oh, she's back in the corner. Steve Connard. Raise your hand, please. Justin Van Houten. Caleb Pearson's running the AV here. Thank you, Caleb. Alan Holstein. Thanks. Our admin, Julie Greer, is not here today. Nancy Economist. Thank you. Hannah Mason, Joe Waniger, and Cheryl Hurst. Thank you for putting this on. I want to introduce Chris Winnan. Where is he? There he is. All right. Here you go. Chris Winnan is a longtime friend of Compass, and he's with Invesco. And so I want to introduce him today, and we're going to take a look a little bit again, about half economic, about half market-based. We're going to look back in 2024, and we're going to look ahead to see what Invesco has for 2025, or at least their outlook. So thank you, Chris.
We will do our best to read the tea leaves. Thank you. Can you all hear me okay? I'll make the old joke. I can get louder. I can't get taller, right? That's my mom said I didn't need enough broccoli as a kid, but I use that same excuse on our daughters. I live in Ankeny, but I do cover this part of the country. I'm going to play Brian Levitt today, our global market strategist, but I'm more of the regional area, Iowa, Nebraska, North and South Dakota. Had the privilege to be with Invesco for 20 years. I'm originally from Chicago, so I'm going to make a Bears reference here in just a second. You guys can mock me about my wonderful sports team. Things are both totally fair game. And fortunate enough that we've got two little girls here. So I think my wife said I've been upgraded to captive from this point from transplant. But certainly happy to be here, and do want to take a little bit of a time to talk through Invesco's outlook. Again, as Guy has said, where we're coming from and where we think the highest probability is as to where we're going. And I do think that this phrase playbook is probably a pretty appropriate one. And getting back to that analogy of the Bears and the fact that we're just coming off the end of what feels like a never-ending football season, that having a playbook is probably a pretty appropriate way to start to say, what do we expect in 2025? Now, I'll tell you, sometimes from an investment perspective, the change of the calendar year doesn't mean a lot. Right? It's just the same environment, but we're going from December to January. Other times it does feel like there are some pretty massive changes. And certainly that's the environment at least from a political standpoint that we're moving into, and that does lead to some changes within an investment philosophy. But I say that because we're going to start broad and then hopefully get a little bit more narrow as we have this conversation. So first, just talk about the players that are on the field, right? Just like with the new Bears head coaching, what do we have in the clubhouse? What do we know? And then try to make our highest probability outcomes as to where we think we're going. And I'm not going to bury the lead here. Invesco is entering 2025 relatively optimistic. We do think that there are plenty of reasons to be hopeful about where we're investing. You really need to ask that question from a market perspective. Are things getting not good or bad, but are things getting better or worse? And if that's the lens that we're looking at, for more companies than not, it feels like things are getting better, not worse, and that should be constructive as an investor. January was a great month from an investment perspective. 2024 was a great year from an investment perspective. So we certainly think there's reasons to believe we're moving in the right direction. Okay, with that in mind, here's the three things that we always try to address when we're having conversations from Invesco's perspective, either as investors ourselves or talking to investors like all of you here in the room. And we do want to make sure that we're eating our own cooking, taking our own medicine. Invesco is almost a $2 trillion asset manager. Now, again, if we talk about politics, those numbers don't sound big, but I promise that's a big manager. We're one of the 5 or 6 largest asset managers in the world. Invesco does mutual funds. Invesco does ETFs. Invesco also has a lot of commercial during basketball, so you'll see the QQQ commercials that are out there. But at the end of the day, a lot of what we're going to talk about shapes the way that we invest, and that really does come down to having consistent principles with investing, making sure that we know what those potholes out there might be. We know you never get hit by the train, right? But what are some of those alarm bells that might be singing in the background? And then we'll finish as we narrow down with our investment outlook. So we want to just ground ourselves with these 3 truisms whenever we talk about investing. And this is really what's made our company so successful over the course of the last 80 years. First, to have a consistent approach. Second, to have courage and not get caught up in the daily news, which only gets louder. Right? I remember doing these seminars back in 2008 and making the joke that Chicken Little seemed like that was the reporter that was talking about how the sky was falling all the time. Those were the good old days now, right? Compared to Facebook and whatever the last tweets are that are out there. And then certainly the importance of keeping our portfolios balanced. Now, you may have seen some charts like this before, but I think this is a good reminder and certainly apropos to what we're going through today when it comes to volatility. There are going to be good days and bad days, but oftentimes the best days to be investors are 1 or 2 days after the worst. And when I was putting this together, I was thinking about really what we saw about 2 weeks ago, which feels like a lifetime ago now, right? In the speed that these conversations go. But anybody remember the Chinese DeepSeek, that conversation, what the impact was from a market perspective? All of a sudden, we saw a big sell-off, especially in large cap tech. It was a record for NVIDIA. It had the largest loss in one day, the day that DeepSeek came out of any company in market cap valuation of all time. Now, if you look at the stock price today, you can see it looks like this, right? It bounced back right away. And that was this truism, is that oftentimes the best days of investors are surrounded by some of the worst. Now, another interesting kind of anecdote for where animal spirits are. I mentioned Invesco runs QQQ. I'm not here to sell any specific investment, I promise, but it is the largest large cap growth investment in the world. The day after that DeepSeek announcement came out, we had the largest single day since 2021 for new money going into QQQ. So big institutional investors and retail investors still believe that the momentum is in our favor, that equity markets are going to go up. And then we saw that big spike from a market perspective. So missing out on the best days makes a big difference from an investment perspective, but in the same way, the knee-jerk reaction to the news, and there's a lot of news that's out there, also can easily derail us. Now, I love this chart. It's a little bit different version of one that we've shown in the past. Now we're actually narrowing it down to just the last 44 years. But I think it's a good reminder to why we always focus these conversations around the U.S. equity market. Now, we know there are lots of other areas that we're going to invest in. We'll touch on bonds. We'll touch on We can touch on the dollar if you want. We can touch on commodities. But ultimately, most of our portfolio success is driven by large cap US equities. And that has been the single greatest contributor to being able to create wealth, frankly, in modern times. This is just going back again to 1980, but it's a $10,000 investment in the S&P 500. And if you go forward over that time period, your $10,000 grew to $527,000, a 52-fold increase in your wealth. Now, eggs are more expensive than they were in 1980, right? Gas is more expensive. A house is more expensive. It is not 52 times more expensive. And then if you also look at the blue charts that are here, I think it's two interesting data points for us to look at. The first, the one that goes up and down all the time, that's the fear index. This is the VIX. If you've heard that before, you can see that there are some periods that we've seen extreme fear in the markets. We saw, Black Monday, right, back in 1987. We saw September 11th and the tech crisis. We saw the financial crisis in 2008, and then we saw COVID as some of those big ones. But there's those other jumps along the way, be it for commodity shocks or natural disasters, Fukushima, Hurricane Sandy, you name it. Something has always been in the headlines and a reason for us not to invest. But what we see and what we believe, and why all of you are sitting in this room, is that inevitable crawl from lower left to upper right just continues that opportunity to compound wealth. So again, we want to make sure that we keep that in mind when we talk. We're not the type of company that's going to say move everything to cash, right? We're not going to time, but we are going to have some strategic outlooks as to where we think the best opportunities are. And that gets to this final point, which is just where we're coming from. The last 11 years has been a very good time to be an investor, right? We've been rewarded from a compound growth standpoint in a very, very meaningful way. Now, we did have a couple of hiccups. We saw the sell-off around COVID, although if you look at it, it really doesn't seem like it made much of a blip from a performance standpoint. And then we saw a sell-off in 2022 that was driven by, I should almost ask, does anybody remember why the market sold off in 2022? It was interest rates, right? It was fear that the Fed was going to restrict economic policy. A couple things. First, the balanced portfolio, that dark blue line, did pretty well, right? You're trying to limit the roller coaster. That's what we talk about for diversification. I've made the joke for many years that nobody gets hurt on a roller coaster unless they try to stand up halfway through. And I think that's also oftentimes true to keeping an investment plan and keeping ourselves invested. I also do think that it's worthwhile to point out there are some extraordinary patterns that have shown up over the course of the last couple of years, really if we go back the last 6 years. And I'm just going to point at U.S. large cap equities. In 2019, large cap equities were up 31%. In 2020, large cap equities were up 21%. In 2021, they were up 26%. We did have a 20% correction in 2022. And then we saw a 26% return in 2023 and a 24% return in 2024. When we're taught in this business what to expect out of large cap equities, we'll typically quote 7 to 10%. Okay, we are above those numbers from a trend perspective, and we'll talk about where valuations are. The other thing that's interesting is that in all of these 11 years, 10 of those 11 years, small caps have trailed large caps. That, again, is not normal, and we believe that there is the opportunity to see some reversion to the mean. Now, that said, if we look at just the last 4 years, equity markets have averaged about a 10% return. So things aren't that extraordinarily over their skis if we just go back and we include this pullback that we saw in 2022. But I do think it's worth just noting that the markets have done really, really well, and that might mean that there's the potential for some change in leadership. All right, so with that in mind, we spent the first 10 minutes kind of talking about where we are. Now let's talk about the things that could potentially get us nervous, right? These are the headlines that are going to come up in the news. And I'm driving over here, and there's different news that's coming out. I think Trump's got an Oval Office meeting today to talk about the big day for tariffs, is what he was talking about. But that's the first one. Second one is global conflicts, which is always something that's evolving that we certainly want to be aware of. What's the impact of U.S. debt? And then we'll spend some time talking about high prices before we move on to what our outlook is. So here's this first concept around tariffs. And I think there are some things that are interesting to note when it comes to tariffs. The first is that we've seen this movie before, right? I mean, that's what's a little bit unique about the environment that we're in today, is that we did go through something very, very similar in 2019. And if you look at that here, that's where this period was. This is where and apologize if I'm saying if this comes up wrong, but the rhetoric around trades and tariffs started was relatively, in this period of Trump's presidency, kind of that second year of Trump's presidency. And as a result, we started to see an increase in prices. Now, what's important about tariffs, because inflation and inflationary pressures are extraordinarily important to how we shape our investment philosophy, is that tariffs themselves lead to price shocks. They don't lead to inflation. And I think that's an important distinction for us to be able to make, is that there's a difference between price shocks, things getting expensive once, versus things consistently getting more expensive over time. And that is when the Fed starts to change the way that they dictate how they use monetary policy. The Fed's mandate is really twofold. It's to keep people employed and to keep inflation low. And they have changed their language about what they consider low inflation. If we go back 5 or 6 years, it used to be to have inflation below 2%. That was the Fed's mandate. Now their goal is to average 2% inflation, which means half the time will be above 2, half the time will be below 2. But tariffs are not necessarily inflationary. They do, however, lead to price shocks. So a great example of this we have on the left, which was laundry equipment. Laundry equipment's one of those things that's become less expensive over time. Now, CPI, we could really get into the weeds there, but they take into account if technology is getting better and things aren't costing more, they would consider it to get cheaper. So if that refrigerator in the back costs the same as it did 10 years ago, but it's twice as efficient, then they're going to say that it got less expensive, even though it costs the same out of our pocket. But laundry machines were a good example of that. The technology was getting better and the price of laundry machines was moving down consistently. Most laundry machines are made in China, right? 2018, 2019, there was that big China trade kind of conflict that happened with Trump. We saw a shock up in prices of laundry machines, and then you had that inevitable falling that reaccelerated itself. So we're certainly conscious about tariffs. We think tariffs can lead to some price shock, and just as importantly, it can lead to trade uncertainty. And we don't have the chart in here, but I'm certainly happy to share it with all of you. Trump's policy around trade is extraordinary in so much that there's more trade uncertainty that we've seen with our trade partners at any time since the 1900s, right? There was 2 big shocks for trade uncertainty. The first was under Trump's first presidency. Then it came back down again under Biden, where things became a little bit more predictable from a trade perspective. And now it's moved up again. Can you hear me okay? Okay. So I think that's just something to be aware of, is that is the instrument that Trump is using in order to get a lot of his policy through. He's a negotiator. That's the mentality. At the end of the day, we probably need to see what the end results are, but it does lead to more uncertainty and potentially a little bit more volatility. So that is something that we are certainly keeping in mind and watching, and it does impact how we're investing, especially internationally. The second, to get back to this idea of international, is what happens from a geopolitical standpoint. What is the impact of war? Now, it's plausible to say that some of those risks, even in the last couple of days, may have slowed down a little bit, right? There's the conversation between Ukraine and Russia that Trump is having, but there's always those external risks. We had what happened in Israel. There's stress that constantly exists between Taiwan and China. If we go to war, what is the impact on our portfolio? And I will tell you, if we go back to the Russian conflict, for example, that we saw in 2020, it was not a great time to be a Russian investor or an investor in Russian equities, right? That was a tough thing. There's individual stocks that are certainly impacted by war. However, it's interesting to see that if we look back at all of the conflicts that we've had, really, and we're trying to go back to the 1960s with some of the big ones that are here, the average stock market returns after those conflicts is actually above average and above trend. So again, could there be additional volatility if global crises continue to percolate? Absolutely. Is it something that we're aware of? But it doesn't necessarily derail us from an investment standpoint, and it hasn't fundamentally changed our investment philosophy, at least here in the US. Okay, the third thing about debt. And look, this is going to continue to be at the headlines. The Congress issued their potential negotiation starting point as to where they want the debt ceiling to be, the $4 trillion increase, wherever those numbers are. But I always think it's worthwhile for us to just remind ourselves debt is not necessarily a bad thing. The U.S. is in a unique position as the default world currency, which makes a huge amount of benefits for us to be able to float and lead debt. And our debt is not extraordinarily outside of the realm of where we've been. In fact, our debt service as a percentage of GDP is still well below where it was 15 or 20 years ago. Now, some of that is because interest rates were higher 20 years ago than they are today. If interest rates stay high, that debt service as a percentage of GDP might continue to grow, and it is one of those potential tail risks that we're looking at. But if we look at this, U.S. debt versus GDP, whereas before we kind of had debt outstanding slightly below GDP as a percentage of GDP, that number has raised a little bit, but within this perspective, it's not extraordinary. The thing that is extraordinary is the growth of the U.S. consumer and the amount of assets that we have here in the U.S. And when we start to put U.S. debt within the concept of what we have from an asset perspective, it starts to look a lot less intimidating. Is this something that needs to be addressed? Absolutely. Is it a conversation that we can see that starts to articulate itself within the bond market? Yes. When you see bonds that are being stubborn and interest rates that are staying high, not bad for those of us that like to buy bonds and have income investments, but it is indicative that the expectations for interest rates to go lower and the expectations for debt are an issue. So this is something that we are certainly keeping in mind. We have no fear that the U.S. is going to lose its place at the table as the default U.S. currency. And we think that the United States is a very solid lender. The assets that we have to back this debt are extraordinary. By many indications, we have $250 trillion in assets versus $30 to $40 trillion in debt. Any bank would make that loan, right? But this will be a huge conversation to make sure that we can slow down that rate of change. Did you want to add something, Guy?
Yeah, I have a little tidbit of information here. For instance, yesterday, the U.S. government auctioned off $66 billion worth of debt, and the debt was a 10-year bond from the U.S. government. And what happened is that bond ended up getting bid on and issued at 4.625%, so about 4.5% interest rate. When it was issued 10 years ago, that interest rate was 2. Okay, so on the current debt that it just refinanced, it's going to pay a higher interest rate. So our payments are going up. Now, in the same, today's auction is $25 billion worth of 30-year treasuries. So you go back 30 years and it's settled at 4.8%, but what was expiring was over 7.5%. So the news isn't all bad. We are refinancing old debt at lower rates, but we're refinancing newer debt at higher rates. So, but overall, the U.S. government is going to start paying more on its national debt than it has up to this point.
Yeah, I think debt service right now is somewhere in the neighborhood of about 3% of GDP, which again is well within historical averages, probably going to pick up to 4% of our GDP numbers. But to Guy's point, it is a complex conversation. It's a complex solution. That's where all the DOGE stuff and the cutting of costs really comes from. So certainly something that we're aware of and want to pay attention to. And I think those are some great data points. This is the other one, just from an economic perspective, that I think comes up a lot in these conversations is, are stocks expensive? Because we started that at the beginning to kind of look at where those 20+% returns were stacked year over year over year over the course of the last 10 years. And the answer is there are expensive stocks out there, right? We are in a market, though, that is pricing the opportunity for future growth for companies like the NVIDIAs of the world, that they think that they have the opportunity to grow into valuations. But if on the right-hand side, you're looking at the S&P 500 and you see the P/E ratio of the S&P 500, simply the price that people are willing to pay for stocks versus how much those companies are earning, we are in that expensive zone. But we would say, though, is different and shapes our investment philosophy is the number there on the left, which is if you look at the average price, the average stock in the market is not expensive. So this one takes into account, it has 40% of the weighting in the top 10 or 12 companies, because those are the biggest companies in the world. That one has all 500 companies equally. And in that environment, the average stock is not that expensive. If we go further out beyond just the 500 largest companies in the US and look at mid-cap and small-cap companies, those companies are below historical averages. Those are cheaper than normal. So what does it mean? It means that there could be a change in leadership. We're seeing to start the year that is happening. It is something that we are optimistic about, that it actually shows that people have a little bit more risk appetite rather than less. But you could see some of those companies that have really driven performance over the last couple of years come back to earth a little bit. So that's the economic outlook. What is Invesco's perspective here? And there's two big questions that we want to ask ourselves and we want to ask investors is first, are we comfortable taking risks in the environment today? And then where do we want to take those risks a little bit more specifically? I love this chart. This is my baseball game analogy. So I'm switching from football to baseball here a little bit. But sometimes in this business, we'll ask the question, what inning are we within this recovery? And to do that, we're going to look at the last 6 big recoveries that we've seen or bull markets that we've seen from an economic standpoint going back to 1970. And the light green line that you see here is where we are today. Now, a couple things that you can start to look at. First, the length of these recoveries start to get longer and longer and longer over time. The shortest recoveries that we saw were in 1970 and 1975. If for some reason tomorrow this bull market were to end, it would be the second shortest bull market. The average bull market typically lasts about 7.5 years. We're about 4.5 years into it. So we're somewhere before the 7th inning stretch in the baseball analogy. We're probably something like the 5th inning. But if you look back to 1990 and 2009, both those games went well into extra innings, right, from an investment standpoint. That said, bull markets don't end because they're 7 years old, 8 years old, 9 years old. They don't die of old age, right? They're murdered. They're murdered by the Fed. They're murdered by economic policy. In fact, one of 3 things typically kills off those bull markets. It's too much borrowing, both either from an individual standpoint or from a corporate standpoint. It is too much inflation, right? And it's too much excess in the market as a whole. So we went back and tried to look at 4 economic environments where the markets did see a change in a bull market to figure out where those ingredients are. These are 4 that we can oftentimes kind of pin our own personal experiences to, maybe not the Great Depression, but that's always the headline news when we talk about it, to say where do we line up today versus those other markets of excess when some of those bull markets ended, and how does it line up with those different periods? So first, let's look at corporate borrowing. Are companies healthy? And you can see that Great Depression certainly is, that was the catalyst, that companies were over indebted in that environment. But if you look at today at a 3.2% rate versus 10 or 11% in the 80s, 2000s, and 2008, companies certainly seem fundamentally that they're very, very strong and very, very sound. Inflation, this was the headline news yesterday, right? That everybody was talking about as the PPI, CPI number came out. The inflation rate went from 2.9% to 3% on core, 3.3% from a PPI perspective. But again, if we look at inflation today, inflation is painful, but it is a lot less than any of these other environments where we saw a big pullback from the market. That was what kind of drove the market down in the 70s and 80s. We've just highlighted 1980. Frankly, you could have looked at any point in the 70s and seen those high inflation numbers. But again, I think it's interesting to see that inflation today is lower than it was in both 2000 and in 2008. Are stocks expensive? We talked about that a little bit. Stocks are certainly a lot cheaper than they were in the dot-com bubble, and the average stock is not expensive. And then household debt as a percentage of disposable income, how healthy are we? Again, you hear those headlines about credit card debt, car loan debt, some of those ticking time bombs that could be out there. Not only are we a lot healthier than we were in the financial crisis in 2008, in fact, household debt is the lowest it's been at any point over the course of the last 25 years. So all of those ingredients just tell us that there's nothing out there that's flashing that's saying the market today is overdue to see that massive correction. And then again, if we look at economic data and risk sentiment, this is how we frame our more strategic outlook. And I'm going to, we can get into this. I'm just going to use a yellow, green, red kind of stoplight analogy to talk through this. Where are we from both a growth standpoint and from a risk standpoint? And this is the thing that's changing the most for us really over the course of the last couple of weeks. This is brand new from our perspective. Maybe see a yellow light or a red light with consumer sentiment, not a surprise, right? Again, I don't want to keep going back to the price of eggs, but I think that's the headline that people talk about. I think people feel like things are maybe declining a little bit. But the good news is business surveys are very, very strong. After the election, we saw some of the highest conviction in small businesses that we've seen in many, many years. Business activity is improving. Construction had been slow, stagnant. We saw real estate prices in a higher interest rate environment started to stagnate, but that's at trend and rising. So I'd say we're green here, yellow turning green here. This is the one word that I would change, would say getting tighter. I'd say monetary and fiscal conditions are tight. Interest rates are still high. They're higher than historical averages. So I think this is yellow, but we think that that is generally getting easier. Monetary policies are getting easier. The labor market is strong. So we would say the U.S. economy is at below trend growth, but our expectations at Invesco is that we are going to move to trend growth as we move into Q3 and Q4. And then the other part is risk sentiment, which is that leading indicator. Market breadth is strengthening. What we mean by that is essentially mid and small cap stocks are doing better than large cap stocks. The dollar is getting stronger, and the momentum trade, companies that are working, are continuing to work more. Now, again, what's interesting is the type of companies that are working has changed. Not just those couple of large tech stocks, the Magnificent Seven, the FANG stocks. We're seeing a broadening in those sorts of companies. Energy stocks have done well. Financial stocks have certainly done well, and those are all areas that we can be constructive with here as well. So here's kind of the four big takeaways that we use to frame our investment perspective from an investment standpoint. And I'll just show you, because I think the most important thing of any of them is monetary policy and what's happening with interest rates. The first is that we are entering into an easy monetary cycle. What's going to happen with interest rates could potentially change as the rate of those rate cuts has changed. We thought that interest rates were going to be cut quite a bit faster, but the direction is clear, is that it's been lower. And an easing cycle, I'll show you in a moment, with no recession typically favors risk assets, typically favors stocks. The second is that a broader stock market in general is our belief is that we're going to see an expansion in the types of leadership. Again, we've got new leadership in Washington. We've got new leadership from an economic standpoint. It also has the ability, the opportunity for those mid-cap companies, those medium-sized companies, to do quite a bit better. Now, interest rates, this is kind of those last two things from a fixed income perspective that are relevant. We are in a higher for longer interest rate environment. We have to reset expectations for mortgages and passbooks that we're not going to go back to 2%, right? Mortgages, we're not going to go back to a 0% interest rate standpoint. So that is supportive for cash. It's not supportive to keep your money in deposits in the bank. But we also believe that at some point this cycle will end. Longer-term bonds typically do well when the stock market sells off. People move towards those defined outcomes. And I say this knowing what I'm saying when I say it. We are seeing generationally high interest rates in those 30-year bonds, right? We haven't seen, you did 30 years ago, yes, you were seeing 7%. But if you use 20 years as a generation, these are some of the highest rates we've seen on the longer end for a long, long time. So everybody in this room is a planner. From a planning perspective, there is that opportunity for us to be able to lock in those longer rates, just to be on the other side of the bank, right? The benefit of a 2% mortgage meant that we could get a really low cost for us to borrow money, but we weren't getting rewarded to lend it. Today, we're getting rewarded to lend it in a bit of a different way. This is the last one that I'll show, because I do just think that from our perspective, our investment philosophy this year, the phrase that we're using is this idea after the landing. And the reason that we're saying after the landing is that was the big narrative over the course of the last 12 months, is can the Fed navigate what is a very difficult thing to do? Because it all was about this raising interest rates to break the back of inflation, but not stopping the economy, right? That's a difficult balance to be able to maintain, because the Fed doesn't have a lot of tools. The blunt instrument of raising interest rates is their ability to put the brakes on the economy. So can they press it down hard enough to slow things but not come to a stop, right? And then when they start to loosen the economy, what are the interest rates? What are they going to do in that environment? Are they going to throw gasoline on the fire, cut rates quickly, which is what we got used to in 2000, 2008, 2020, or will they slowly start to add some energy back in to keep the economy stimulated? And our belief is that the Fed was able to do that, to be able to walk that narrow tightrope of starting to loosen rates. You could have made the argument that maybe they waited a little bit too long, but it all seems like it's kind of worked out. And that's the environment that we're looking at here from an interest rate standpoint. We've all heard that terminology, don't fight the Fed. Well, here's the reason why. The Fed is either cutting rates going because the economy has already hit a recession. Now, that means that the stock market's already sold off. You're buying stuff on sale, right? Not a surprise that stocks go up. The Fed cuts interest rates too late to try to stem off a recession. That's that pink line. Our belief is that we are not entering into a recession. And when you have an easing monetary policy, not entering into a recession, stocks again do very, very well. In fact, risk assets of all sorts do very, very well. Commodities do well, high yield bonds do well, and equities do well. And that's what shaped our investment philosophy. So Invesco does think that the market is getting stronger. We did enter the year with a little bit of a risk-off positioning. We were overweight large-cap U.S. equities, underweight international stocks, and overweight high-quality bonds. As we've moved into the year, we continue and we will continue to increase our weighting down the market cap spectrum. We're going to be buying more mid and small cap stocks within our portfolios. We've started to buy a little bit of international equities as well. We're still underweight, but we're increasing our positions there. And we do think that within cash, we're not necessarily taking a huge interest rate bet, but we do think that there's opportunities in fixed income for us to be able to make money here as well. So I think that's kind of the takeaway, is there will be and there will continue to be a lot of noise from an economic perspective. And if we remember from 4 years ago and 8 years ago, the policy of the administration that we're in right now is certainly one where there's going to be a lot of information, a lot of tweets, a lot of additional, probably can just skip through these, conversations that are going to come up. But if we ask that question that I said at the beginning for the playbook, are things getting generally better or things getting generally worse? We're still of this belief that as a whole, from an economic standpoint, things are still getting a little bit better. And if that's the case, and if they're getting better for more companies, especially those companies that are a little bit smaller in the market cap spectrum, those that have to deal with debt, borrowing, that's an environment where you want to be an investor. At the end of the day, you guys are all very fortunate, and I do say that because they're standing in the back of the room, but I would say it anyway, that you've got great stewards of your capital. You've got great folks that are out here to get you to those first ideas of consistency, of balance, of perseverance, and of being able to stay buckled in when the market will inevitably give us a softball. We will inevitably get hit by that train that we don't see. But our thought from an investment perspective is the economy is strong, it's improving, and there's plenty of great opportunities for us to be able to stay invested. So, Guy, with that, I'll pass it back to you, and I appreciate it.
Yeah, thank you. Stick around, Chris. We're going to have questions at the end here. I want to add just a few points. Is number one, something interesting is happening in the interest rate environment because the Federal Reserve has been cutting since last fall, and they cut short-term interest rates. In fact, what they deal with is the interest rates that banks charge each other for overnight lending to each other. Okay, so they're on the very short end. These are one-day interest rate loans. That's what the Federal Reserve is setting. The market, however, sets the long-term rates. So the 10-year, the 30-year, that's what the market is out there setting. So even though the Federal Reserve has cut interest rates about 1 percentage point on the very short end, the market has raised interest rates on the longer end. So we see things that consumers care about, auto loans, mortgages. We've seen those go up even when the Federal Reserve has been cutting interest rates. So very interesting situation going on there, and it's confused a lot of people about what's going on. So another thing, Caleb, will you go back, or can I click back through? Go back to the first one. I want to talk the long-term stock market performance. I want to talk through that. Yep, right here. Nope, that one right here. So it's interesting because this starts at 1980. And if you were to go back pretty much to 1965, so the prior 15 years, it was an awful 15 years. And if you had $1 in 1965, you had quite a bit less than $1 by 1980. Another interesting time period is when I kind of, I guess, came of age. I graduated from college in 1999 and put my first dollar in the U.S. stock market in my 401k in 1999 right here. And I remember sitting in Kurt Pearson's office all the way over here in 2012, and my dollar that I put in back here wasn't quite worth $1 again after all that time. Okay, and I remember asking him, like, Kurt, I thought this was supposed to work. Well, the reality is we went back and looked at the math, and I had invested every single month all throughout this time period. And guess what? So when you look at the total returns over that time period, I was buying all through that. And I got some real deals down here when the market was way down. So my total return over that time was actually quite favorable, but it was stuck in my head like, how does this work? But it does work when you continue to buy something that has a long-term track record of going up in price. So those are two things I just wanted to comment on. I'm going to get now to the local stuff here. So number one, the Iowa GDP over the last 12 months has grown about 2%. And by GDP, I mean the total value of the goods and services that we produce in Iowa. Okay, so up about 2% over the last 12 months. Over the last 5 years, annualized, it's grown about 3%. So last year was a little slower than we've done for the last 5 years, but we've had decent growth between 2 to 3% every year over the last 5 years here in Iowa. Our demographics, we now have 3.22 million people in Iowa. That is up a little less than 1%. And by the way, all of our population increase was from international immigration. Iowa has no natural population increase. All of it comes from international immigration. Very interesting topic. I'm going to talk a little broadly about Iowa real estate, and then I'm going to drill down into the Des Moines Metro real estate. So Iowa real estate, single family homes, the price rose by about 6% and is right now on average about $220,000 is the average sale in Iowa for a home. They spent an average of 45 days on the market, which was up quite a bit from the prior year. In December, new listings were up in Iowa about 6%. Total home sales were up about 9%, and the price was up about 15%. And also, it sat on the market for longer. Okay, so that's Iowa as a whole. Let's look at the Des Moines Metro. And when we consider the Des Moines Metro, it's about 850,000 people now. Let's consider the Des Moines Metro, closing in on 1 million. And the Des Moines Metro accounts for about 35% of all the sales in Iowa, which is interesting. The median price is higher here, as you may expect. It's about $250,000 in the metro, and Iowa is at $220,000. So, in the Des Moines Metro, homes spend an average of 79 days on the market, right? So it's taking longer to sell. However, home sales are up to about 13,500. Mortgage rates, not only are the home prices higher, but mortgage rates are higher, which makes it more expensive for a couple or a person beginning in life to get into a house. That's causing some problems. Very few homes below the average. So below $240,000, those are tough homes to find, and not a lot of them on the market right now. So, but generally, people think this is a strong market, even though interest rates are a little higher and it's more expensive than it has been in the past to get into homes. Let's move on to Iowa farmland. Last year, in 2024, Iowa farmland values decreased about 3% across the state on average to roughly 11,500 per acre statewide. Now, of course, that differs quite a bit in different parts of the state because there's better agricultural land in north central Iowa than there is necessarily in some other parts of the state. But this decline in farmland value actually ends a 5-year trend of increasing values. So for the last 5 years, things have been up, up, up. This year, they were down a little bit. Looking forward, they do expect a decline again this year, but professionals are optimistic about expecting an increase of between 10 and 20% of farmland values by the time we hit 2029. Okay, so in 5 years from now, 4 or 5 years from now, they do expect it to be 10 to 20% higher. Iowa banking health. there in 2024, there was 5 bank failures in Iowa. And that is the first time there's been any bank failures for the prior 4 years. Now, typically these were little banks, and what happens in these cases is the FDIC comes in and makes a deal for that failing bank to be bought by a healthy bank. Okay, so you don't usually hear much about these, or they're pretty small banks, but generally local banks are very healthy. Their deposits are up 3%, their assets are up 4%, their income is actually down, which would explain because of the change in interest rates. So when interest rates are higher, right, banks make more. Interest rates are a little lower, at least on like the CDs, what you can get in CDs now. So net income is down a little bit, but of the 236 banks domiciled in Iowa, generally they've grown about 4% over the last 12 months. Okay, next I am going to talk about the ag economy, which is really interesting. And I come from this background. My family are pig farmers, and so I guess I found out real early in life what I didn't want to do for the rest of my life. But I'm still very connected to the ag economy. By the way, in 2024, crop yield growth was about 10%. Okay, pretty good, and that's improved genetics, improved land care options. So about 20% of Iowa workers are considered employed by a farm or in an ag-related industry. So it's a very important part of our state. There has been some layoffs so far in 2024 at 7,000, and most of those coming from the manufacturer segment. John Deere. There's a lot of ag manufacturers in Iowa too that are doing some laying off. 50% of businesses, however, said they're expecting to expand their staff in the next 3 years. So there's a lot of hope there, at least on the manufacturing side. Net cash in farm income is expected to be about 3.5% lower. Was 3.5% lower in 2024 versus 2023. And sale of agricultural products, there was an 8% increase in animal sales, right? Hogs being one of them, but a 9% decrease in crop receipts. Okay, so less on the crop side, more on the animal side, and those two tend to work in pendulums over time. And the median farm income in 2024 was a little over 100,000, which was 3% higher than it was the year before. So what I'm hearing about the ag economy is that prices are down and that people expect to earn less, some of them much less in 25. That's the general outlook about what's going on. And when we talk about Iowa, a lot of our economy does depend on commodity sales. That is an easy target for China in tariff retaliation, because China doesn't produce all the food or energy it needs. And so the Midwest and the US produce more corn and soybeans and hogs and cattle than we need. So that is a big export for us and a big import for China. So, we talked about tariffs. That could be an area of uncertainty. I talked to a CPA about state taxes and federal taxes, and I'll cover that and then we'll wrap up. In Iowa, 2024, the top rate is 5.7% for income taxes. The 2025 rate this year is 3.8%. Okay, and they accelerated that because in the past that was meant to be our rate next year, but Kim Reynolds and the government pushed it forward to this year. And that's 3.8% for all types of income, which is different than the federal government because the federal government taxes your income in different ways. State of Iowa looks at all your income exactly the same. One big change for small businesses is bonus depreciation is going down to 40%. In 24 it was at 80%, and essentially means if you're a business owner and you buy something big for your business and expensive, in the past you could write off 80% of that in 1 year, in the year that you bought it, And that is slowly going down over time. So you can take a little bit of it this year, a little bit of that cost next year, and it spreads it out. So that bonus depreciation is going away. Let's see here. Oh, this gets into some federal stuff here. Okay. Sorry, I didn't do a good job here. But federal taxes, for most, there is no major changes from 2024 to 2025. Very steady. Some tax brackets and standard deductions increase by the inflation amount. The standard deduction for married filing jointly now is almost $30,000. And for most couples, that's a very high hurdle to clear because versus itemizing. So most people don't itemize anymore. Under special circumstances, you may itemize. Typically, those people either have a huge year of medical bills that become deductible, or they're very generous in giving away large amounts of money. Okay, so those two people tend to be able to itemize versus taking the standard deduction. Because of Trump winning the presidency, most people expect that the provisions in his 2017 tax bill that were supposed to expire at the end of this year will be extended. And as my CPA likes to say, hey, Congress has a long history of extending the popular things and letting the unpopular things expire. So that's generally what will happen. One big thing out there is the estate tax. The estate tax is a whole different system versus the income tax. And right now, the estate tax exemption, meaning if you have assets over $14 million per person and you try to pass that on to the next generation, they tax 40% of the assets that you pass over $14.5 million per person. Okay, so that is a huge tax if you have a bunch in assets. At the end of 2025, that exemption is set to be cut in half to 7 million. Okay, still awfully big amount. And when you have a couple, that's 14 million per couple, but it's still half of what it was. And so I think there's going to be some, again, Congress likes to extend things that are popular and likes to cut things that are unpopular. So that is still something out there that is yet to be resolved. But overall, both state and federal tax situations are very stable for tax planning, which is what tax preparers like to see. Okay, so a lot of this uncertainty has been cleared up, at least on the tax side. We have time for a couple of questions. Chris, why don't you stick around? We got about 5 minutes. All right, I'll give you this so the people online can hear.
I'm new at this stuff. And when you said that the U.S. debt was being sold, who's it being sold to? Americans or foreigners?
So that's a good question. That's a little bit of industry talk. Here's what happens when the U.S. government needs money. They sell a bond. Okay, so they get some money and they give you or whoever the buyer is an IOU. And if let's say that's worth $1,000, so you give me $1,000 as the U.S. government, I give you a bond, which is an IOU for $1,000, and there's an interest rate associated with that, and I will pay you every year whatever that interest rate is. So if it's 5% on $1,000, that's $50 a year. So you get $50 a year, but that bond also has a limit on it, a time limit. And the most common one is 10 years. So I borrowed your money for 10 years. I pay you interest for 10 years. And at the end, you give me back the bond and I give you back $1,000. So who are the buyers of U.S. debt or U.S. bonds? Many pension funds. Anybody know a popular program called IPERS here in Iowa? They own lots of bonds. How many government bonds does Invesco own on behalf of their clients?
I'd say anybody who wants to own that is anybody who wants a defined outcome. So the percentage of assets, it was a huge narrative about China, Japan before that buying US bonds. They were just buying it because it was the safest thing out there and it had the highest yields. That percentage of our debt that's owned by foreign governments has been coming steadily down. But anybody who wants to own it is exactly what Guy's saying. It's anybody who wants a defined outcome to know exactly how much money they're going to make over the next 5 years. So who's that? Pensions, insurance plans, and individual retirees, and then in companies like ours as well. So anybody can buy it. They buy it at whatever the lowest rate they're willing to take.
Yeah, so it's interesting too because Warren Buffett has talked about this in the past when people come to him and say, "Well, what do you think about the US government being so far in debt?" And his point was, if I could sell bonds and pay people back with Buffett bucks, right? Kind of like the US sells its debt and the US creates its own dollars. He goes, I don't have any problems in the world because if I need more money, what do? I turn on the printing press. I bet Steve has something to say about this.
He knows me very well by now. No conversation about who's buying the U.S. debt is complete without mentioning the Federal Reserve. When we go back to COVID and we saw this huge spike in government spending that has persisted now for a few years, there weren't exactly a long line of buyers, foreign or otherwise, lined up to buy all that debt that had to be issued to finance the spending. So the Fed created the money by pressing a couple buttons on their computer keyboard. They created the money and they bought all this debt with printed money. And so the debt that they have on their balance sheet is huge. Now it's coming down. They're letting it run off, but they still have a lot of debt to liquidate. And but they are the buyer of last resort. When there wasn't anybody willing to step up and buy our debt, they bought it and they settled for really almost nothing for interest rates on it. And so it's kind of a magic trick there. So I just thought I'd let everybody know that's been a big part of our finance picture for the last 5 years.
All right, thank you. What other questions do we have? Anything else?
You mentioned Iowa's population has grown significantly, it sounds like, but that it's from people coming into the state. Is there any indication how many of those people are illegal? And if the deportation is rolled out, how's that going to affect state economy?
Yeah, that's just not a state question. That is a national question too, right? And again, I will tell you, being from a family in the hog industry, it is difficult to staff hog barns with people, natives, I would say, native Iowans. It's so immigration is a huge answer to labor in the ag, not just in Iowa, but who do you think picks everything out in California that they're doing in the Central Valley? So it is a major thing. Uncertainty, right? What's Invesco's take on that?
Oh, just a softball, right? No. Demographics are extremely important, right? And that's going to be, I think, a really interesting narrative, maybe not today, but over the course of the next 10, 20, 50 years. How are we going to be able to replace demographics? Now, one of the solutions is potentially technology, right? Can some technology make up for that labor gap? It's going to be hard in a hog barn. But theoretically, there's places that you can use technology to become either more efficient or to have some of that AI maybe take part of it. But that has been one of the strengths of the United States, is to be a net importer of people, right? So that we can continue to grow without necessarily those birth rates. So it is an interesting question. It's a one that China is wrestling with their the implications of their one-child policy. It's something that South Korea and Japan are wrestling with. It's something that Western Europe is wrestling with, is how are they going to replace a population that potentially could be getting smaller. So I think it's a big question. To your point, I think there's some uncertainty to it. Could it lead to some shocks in individual businesses, agriculture that we'll have to address? Absolutely. But what will the impact over the course of the next 10 and 15 years? Those are big questions I don't think anybody really has an answer to. Again, our solution here in the United States, at least in recent history, was to bring in, to have immigration, and you can make that argument whether it's legal or illegal. Is it probably a very big policy conversation? But that was what was replacing some of our situation, both in Iowa is kind of the microcosm to it. So,
Well, I will tell you this, my experience in the hog industry says that there is no appetite in Washington, or there hasn't been for many years, to create a bigger legal pathway, because the legal pathway is very narrow and very difficult to navigate, especially for people that don't speak our language and things like that. So there's a lot of work all around immigration that needs to be done to create a bigger legal pathway, because we need the help. And by the way, the nation's numbers mirror Iowa numbers. We're not growing naturally as a nation. Almost all of our population growth comes from immigration, and I think has for quite a while. We are pretty much out of time. We want to thank everybody for coming. I want to thank you, clients, for choosing Compass. I want to thank you for your trust, and thank you for your business and your referrals. This is how we grow. Invite your friends. Remember what's coming next month. We're going to talk about the generation that's inheriting, and very few people are talking to that generation. So the event next month, How to Inherit. Thank you for joining us if you're with us virtually, and have a wonderful day.